Hey everyone, welcome back to Upside Down Data. Today I want to talk about a couple different metrics and ask the question, is it possible, is it plausible, is it conceivable that we're at kind of the later stages of the bear market? You know, the price has been down only for so long. Is it conceivable that we might be getting into the later stages, or not so much? Is it very plausible that we're just going to keep going down? That's what I want to talk about here. So the first metric that I want to look at is one that we haven't talked before about on the channel, but I think gives an interesting perspective on bear markets. And that's just looking at network activity on Bitcoin, specifically looking at just the transaction count, kind of the number of transactions going on chain, and get an idea of what this might tell us about how bear markets tend to play out. So this is a graph from Chain Exposed. And really with this, we have a couple bear markets we can look at, right? We can look at the 2015 bear market, the 2017-2018 bear market, and then, you know, the current bear market we're in right now. Now, I want to start with the 2017-2018 bear market because there's an interesting pattern that emerges when you look at this, right? You know, you get this build up in activity on chain as the bull run happened in 2017, which you would expect. You know, a lot of euphoria, a lot of interest, a lot of people probably getting in, you know, buying Bitcoin, selling Bitcoin, just a lot of activity. This is characteristic of a bull market. You also see it just with order flow data. You know, exchange volume will go crazy during a bull market because a lot of people are interested. There's a lot of enthusiasm, etc. Then what you'll notice is that, you know, the on-chain activity is characterized by some massive drawdown in transaction volume following the local high. You know, the end of that bear market. You know, you have this blow off top, price crash, or excuse me, transaction volume, and in this case, transaction counts will crash off a cliff. But then what happened in 2017, 2018 in that bear market is you actually saw this kind of divergence play out where the price was falling, but transaction activity was actually rising. And then, you know, it actually ended up rising into the ultimate capitulation at the end of 2018 and actually kept on building beyond that. So once the actual bottom was in, transaction volume still continued to go up. And then that, you know, led to this big kind of relief rally in 2019 that then, you know, led into the March 2020 crash. Now, 2015 was a little bit different, right? We didn't see that super marked, you know, drop down in transaction count like we did in this bear market here. There's a bit of a dip, right? You'll see the all-time high, the spike in the transaction count at the time, and then this kind of small drop down. But then you kind of saw it's sort of a similar pattern, just kind of less, you know, severe of a drop down here. You know, transaction volume increasing into the ultimate capitulation, then following through into what turned out to be that big parabolic run into 2017. And so one way that we can look at bear markets is it seems like it might be the case that you get to these peaks, these periods of euphoria where everyone's getting in, everyone's excited, and then you get kind of a first big crash, a first big capitulation moment. You know, in 2017, that would have been right around here, where you get this first big crash that scares out a lot of the kind of early or later entrants potentially into the market. The people got in at the euphoria, scares them out, they sell out, get out of the market. Network activity just drops off a cliff as people just aren't really using it all that much. You probably have a lot of people who are expecting higher prices, so they just are holding their coins, they're not spending them at these levels. Things just kind of relax. And then as the bear market deepens and deepens, you get more and more transactions of people who maybe were holding from up here, hoping for higher prices of recovery, finally capitulating, they're getting out. And then you get this final capitulation out that corresponds with an even higher amount of transaction. You see actually in this capitulation here, the high number of transactions they're having on chain kind of leading into that. You know, a lot of coins changed hands during that big capitulation. But then what's interesting is that once that final capitulation happens, you don't actually see this drop off on activity. You actually see it increasing. And this is probably reflective of accumulation to some degree, where you're getting kind of over time a bunch of people who are selling out and a bunch of people who are buying in. So there's a lot of changing of hands, even though the price is actually remaining relatively consistent. And this is on-chain transaction, right? This is people spending their Bitcoin, pulling Bitcoin in. That would be diagnostic of a kind of accumulation type of a pattern. And then, if price starts to go up, then the transactions tend to go up as well. And we've actually seen this sort of similar pattern play out if we treat this as kind of the all-time high. Now, technically it's not, right? The all-time high was over here in November. But a lot of people say that on-chain, the all-time high really was actually January. A lot of the metrics spike for on-chain. You actually see it here too, with January as being kind of maybe the the on-chain quote-unquote blow off top, even though price did grind up further. And then really this May capitulation being something analogous to this 2017 crash in transaction count. And we saw that here. And maybe what we're seeing play out to some degree is this kind of similar pattern where you get this everything falling off a cliff after the euphoria phase, which I think definitely this phase was more euphoric than this one. I think just anyone who remembers this time, remembers how crazy mania it is. Some of that came back here, but not to the same degree, I don't think, as what's going on here. And we saw, transaction counts starting to kind of recover, and now price has been falling. So there's been kind of this divergence, right, where we had the lowest transaction count back in the lows of the summer. We're now at lower prices. We actually have had higher transaction counts, a similar divergence to what we've seen in the past. So if we ask the question, is it conceivable that we're getting towards the later stages of the bear market? I think certainly. Now, what this indicator won't do is tell you where the bottom is, and I've gone on record, and I'll repeat here again, I don't think trying to call the bottom is a very good use of time because no one really knows. No one has no idea what the bottom is. But if you're asking the question, is it conceivable that we're getting towards the later stages of a bear market? If historical patterns play out again, this would suggest that a similar kind of, at least from the perspective of transaction counts, a similar profile is playing out here as is what has happened in prior bear markets. Now, of course, the big elephant in the room is the macro environment and the possibility that this time is different, right? Back throughout Bitcoin's entire history was just in a macro bull run. Now there's a lot more uncertainty and a lot more fear in financial markets, really, than any of these times in the past. 2018 was a time of a lot of fear in the market, but that was low inflation environment. The Fed was able to step in and, go back into quantitative easing mode probably a lot more easily then than they will be able to do that now. So there are a lot of things that people can point to why this time might be different. So that's the caveat you have to take all these data with, is that, just because it played out that way in the past doesn't mean it has to play out that way again in the future. And, a lot of people, I think, have been led astray by assuming that historical patterns have to repeat. They don't. But if we're just asking the question of plausibility, I think this would suggest that it is certainly plausible we're getting towards the later stages of a bear market, like what we saw here, and, like we saw, coming in from, here, then going into here. So let's talk about another indicator. Now, this is one that we have here at the channel, the momentum bias indicator, that also gives us a nice profile of different bear markets and just lets us kind of look and see if similar patterns are showing up. Again, giving us this idea of plausibility. Is it plausible that the capitulation down to 17.6K could be maybe that big kind of puke capitulation? Is it plausible? Not to say it's guaranteed or certain or that we're calling any bottoms. Just talking about possibility or plausibility. So if you're not familiar with this indicator, what it's getting at is the prevailing momentum in the market. So a positive momentum bias means that there's more upside momentum than downside. So moves back to the downside quickly get reversed to the upside. And then a negative momentum bias would be the opposite. That's bear market behavior. That's when the negative momentum is prevailing, moves back to the upside just quickly get rejected. And what we can see is that there are different kind of behaviors that the MBI tends to engage in different market phases, right? We've talked about this before. When you're in a bear market, like we're in now, you spend a lot more time in the red than in the green. And in a bull market, it's the opposite. And then really kind of that transition between bear and bull market tends to be characterized by this kind of oscillation around zero, right? You kind of see the MBI start to track kind of up and down around zero, and then it puts in a really strong bias one way or the other that kind of leads us into the big parabolic run. And so when we look at this, what we can see with the MBI is we're in, very much kind of bearish behavior right now, bear market behavior, and we're seeing that. And when you look at it, there's kind of different behaviors you can observe where you'll get this kind of initial big puke, right, where there's this big surge in negative momentum bias that really pushes it down to a deeper level. And then we might come up, poke our head up above zero, maybe once, maybe twice, like twice over here. And then you puke down to the ultimate capitulation that marks the bottom, right? We saw that here, 2014, 2015. See this puke down. Got another one about the same level than the ultimate capitulation that was markedly lower than the first one. Saw this in 2018. We get this first big dump down in negative momentum bias into this big drop down here. And then you get finally the big puke down in the end of 2018 here, and that marked the actual bottom. And you could look at this and say, again, if we say that this was kind of the beginning of the bear market, even though technically we put in a new high relative here over here, if we go from the kind of the on-chain definition kind of the low excitement kind of definition of a bear market that some people argue for. If you call this the beginning, or if you just call the bear market starting over here, see a similar behavior. You get the first big puke here, or you could define it as being here, and then you get a deeper, nastier one a little bit later. And so if we're asking the question, is it plausible that this is getting to the later stage of the bear market? The behavior of the MBI has been acting out very much in a similar pattern to what we've seen in the past. But then again, the caveat being that just because we can identify these patterns in past behavior, market cycles, doesn't mean that it has to necessarily act out that exact same way again. So by no means is this saying the bottom is in, but if it's saying, are we getting to the later stages of the bear market, saying, sure, it's plausible, right? If historical patterns play it again, this kind of behavior would be exactly what you expect to happen. And it might very well mark kind of a transition zone. But again, with macro environment the way it is, I don't say anything like this as being definitive by any stretch of the imagination. And, a puke down further than this could certainly be in the cards. But again, I think there's some people who are trying to make the claim that it's not even possible that this is the lows that we're going to see. I'm not going to make that kind of a claim yet. I think that's just as dangerous of a claim to make as to say that this is the bottom, right? I think the way to navigate these markets is in the realms of plausibility, and just always keeping an open mind of what is more or less plausible. We're just asking the question, from prior behavior, is this a plausible endpoint of the bear market? This certainly seems like it, and it seems more like it than, this drop down was back here from this perspective. But all this said then, and again, I've been hedging a lot of this by saying, we don't know if things are going to play out the same way again, so kind of always be careful. The model I want to end with, kind of on that note, is one that I personally am going to be looking at quite heavily as terms of when I might actually start being more optimistic that the market might be changing direction. I'm not going to be, holding, too much in these speculations about prior behavior and some of these other indicators where we just really don't know what's going to come next. The nice thing about the market direction classifier, MDC, is it's really designed to capture macro shifts in the market, macro trend changes in the market. So if you're not familiar with this indicator, basically what it does is it assesses the asset's price action, and then it creates a critical level that it's watching, that if the asset is above that critical level, it's bullish, and it means that the trend is likely to continue to the upside, for example. Or if it flips below that critical level, that's bearish, it means the trend is likely to continue to the downside. And you see it does a pretty good job of identifying these more macro points for Bitcoin, these kind of macro uptrends and these macro downtrends that it's been in. And right now, except for this little blip above back in late March, early April of this year, it's by and large just been, in the red zone, kind of below the critical level, very much in a bearish footing. And the thing I like about looking at this indicator versus something like the 20-week is if I just overlay the 20-week here in purple, we can see that the MDC just does a way better job of kind of getting you in earlier on these trend shifts to the upside and getting you out sooner on these trend shifts to the downside. You'll see this repeatedly. It gets you out sooner and then gets you in earlier. Gets you in way closer to the beginning of these trend shifts generally, then out closer to the tops than the 20-week moving average would be doing. So, a lot of people look at the 20-week as kind of being this gold standard for identifying, are we in a bull or a bear market? I respectfully disagree. I personally see the MDC as being a more useful tool for that. Now, it's not to say that the MDC won't sometimes get a little bit faked out, but in the cases where it does get faked out, if you were to be using it to give you trade signals, you're not going to be losing money. The MDC at worst will just be flat through that. So if you sold and bought back in, you should be selling and buying in at about the same price level, not really losing much. But then you're getting in and getting out a lot sooner than something like the 20-week. And also the 20-week gets faked out too. We hopped above the 20-week back over here and then fell back below it. So it's not perfect from that perspective either. And so really what I look at the MDC for is kind of being a way of managing risk in these markets where we don't know what's going to happen next, to kind of see what does this think about the trend that we're in. If it's looking bearish, then, it can save you from a heck of a lot of down, right? If you had sold off when the MDC flipped red up here, it would have saved you from all of this misery, all of this pain. You would have been sitting quite happy probably up in the kind of 50K. I think this is kind of mid to upper 50K range that would have had you selling up here after the November high, which I think anyone now would be delighted to have sold their Bitcoin back up there now that we're trading, down around 20K. So the nice thing about this indicator is we can look at the exact critical level it's watching at a given point in time. Right now it's watching for 24,100. So if we flip above that, that would be bullish from its perspective. That might be a sign of a trend reversal. But as long as we stay below it, it doesn't seem much reason to be too excited. This is a dynamic level. We'll be changing over time. So I'll keep people updated about where it is. So right now we are, appreciably below it, but we're a heck of a lot closer to it than we are to the 20-week, which is up still in the low 30K range. But again, really the point of this video is that we're asking questions, is it possible that we're at the later stages of a bear market? Absolutely. I think it's very much possible that we could be there. But really then, when for me personally, not financial advice, you should make your own decisions about these investments. But for me personally, I'm not going to get too excited about Bitcoin going on even a relief rally, a short-term relief rally, until we can reclaim, kind of flip over the MDC's critical level. Until we can do that, I'm going to be still exercising caution and thinking that downside is very much plausible. So it's possible we're at the end, but until we start seeing some of these signs of hope, I'm not going to be, calling the bottom by any means. Not that I really call the bottom anyway, but I certainly wouldn't be calling the bottom until I see some of these more favorable metrics flipping bullish. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates, better indicators, and more over there.